I sold whole life insurance for 11 years. I was very good at it. I sat across from people who had just had their first child, people who had just buried a parent, people who were scared and who desperately wanted to do something right for the people they loved, and I sold them a product that paid me extremely well. I want to tell you what I told them and what I didn't. There is one moment from year 3 that I still think about. A couple, late 20s, new baby, rented apartment in New Jersey. He worked in logistics. She had just gone back to work part-time. They had about $4,200 saved. They were doing everything right with what they had. I walked out of their apartment with a signed application for a whole life policy at $4,800 per year. My commission in year 1? Around $4,000. Their cash value at the end of year 1? Less than $200. I knew that. I did not say it. For a long time I told myself it was fine, because they were protected, because the product was suitable, because over time it would grow. I told myself the story that every agent tells themselves, that the protection component alone justified the structure, that the conversation was honest, even if the math was never laid flat on the table. I've had 11 years since to run the actual math. The story doesn't improve. Before I open the hood on any of this, I need to give you something to hold. At some point in this video, I'm going to give you one specific question, one sentence that you can ask an insurance agent mid-presentation. Not aggressively, just directly. One question that changes the entire dynamic of the room. Stay for that. My legal team has reviewed this video. They've asked me to clarify that nothing here constitutes financial advice. They've also noted, unprompted, that they switched to term insurance after watching the rough cut. I'm not drawing any conclusions from that. Let me walk you through how a whole life insurance presentation actually works. Not the brochure version, the real version. You're 32 years old. You've just had a baby. Or you're thinking about having one. There's a very well-dressed person sitting in your living room with a leather portfolio and a warm, unhurried smile. They've brought a nice pen. They've remembered your spouse's name. They ask you, what would happen to your family if something happened to you tomorrow? And for a moment, a real moment, you actually sit with that question. The mortgage, daycare, your spouse alone at 2 in the morning with a newborn and a stack of bills and absolutely no idea where the insurance documents are, if there even are any. Your kids in 10 years, college, a future you're no longer in. That fear is real. That fear is entirely legitimate. And the conversation this opens about protecting the people you love is a conversation worth having. Here is the critical thing I need you to understand. The agent knows exactly what just happened in your chest when you thought about it. I knew. Because I had been trained to ask that question in exactly that way, at exactly that point in the conversation, with genuine care, with unhurried presence, with the kind of warmth that takes years to develop. Not performed warmth. Real warmth that had been channeled over time into a very specific commercial outcome. That's the part they don't train you to notice. The care is genuine, and the direction it's pointed serves a purpose. And then, almost always within 60 seconds, comes the pivot. What if I told you there's a product that does 2 things at once? Protects your family and builds wealth at the same time. 2 in 1, insurance and investment, bundled together. The Swiss Army knife of personal finance. And sitting in your living room, scared, wanting to be responsible. That sounds like the answer. Here's what happens when you open the hood. In the first year of a standard whole life policy at $5,000 per year in premiums, A very large portion of what you pay does not go into your cash value account. Not a small portion, not a rounding error, a very large portion. It goes to the agent's commission, to administrative fees, to the insurance company's cost structure for maintaining this product over its lifetime, to what the industry calls loading, the layers of overhead baked into the premium structure before your dollar ever touches anything resembling an investment. Industry data on this is consistent. Agent commissions on whole life insurance typically run between 70 and 110% of the first-year annual premium. On a $5,000 policy, that's somewhere between $3,500 and $5,500 to the agent. In year one, your cash value at the end of year one? Often close to zero, sometimes literally zero. In some policies, you'd have to surrender the policy immediately to discover there is essentially nothing there yet. Years 2 and 3 aren't dramatically different. The surrender value, what you'd actually walk away with if you canceled, often doesn't meaningfully clear what you've paid in until somewhere between year 5 and year 7, depending on the policy structure and the company. 5 to 7 years of payments before you break even on what you put in. I want you to sit with that for a second. When someone is sitting at your kitchen table, talking to you about your family's future, about love and responsibility and protection, they may be collecting the equivalent of your entire first year of payments before your account does anything meaningful at all. I knew this. Every good agent knows this. We just didn't lead with it. But Alistair, it grows after that, right? The first year is rough, but then it compounds. That's the whole point. Yes, it does grow. So let's actually run the numbers, because this is where whole life either earns its place in your financial plan or reveals itself for what it is. Meet Daniel, 34 years old, married, 2 kids, household income of about $80,000, has a mortgage, wants to do right by his family, wants protection, and wants something growing in the background. A very reasonable person with very reasonable goals. Option A is what he's being shown across the table. A whole life policy at $5,000 per year. Over 20 years, Daniel pays in $100,000. His illustrated cash value at year 20, and I want to be precise here because agents are legally required to call these illustrations, not projections. And that distinction matters enormously. His illustrated cash value sits somewhere between $60,000 and $90,000. Some of that growth is the guaranteed component. Some depends on dividends, which are not guaranteed, and which insurance companies have been quietly adjusting downward for years as interest rate environments have shifted. His death benefit, $300,000. His total paid in, $100,000. Now, option B. Daniel buys a 20-year term life policy. Same $300,000 in death benefit, same coverage for his family. His annual premium, based on his age and assuming reasonable health, approximately $800. That leaves Daniel with $4,200 per year. Not to spend, to do something with. Now, I'm not recommending any specific fund, account, or investment product. That is genuinely not what this is. What I can show you is what historical data looks like over 20-year horizons. Broad equity markets, over long periods, have historically produced average annual returns somewhere in the range of 7 to 10%. That is historical data. It is not a promise. Sequences matter. Markets fall. Starting points and ending points affect outcomes significantly. But as a reference frame, $4,200 invested annually, compounding at 7% over 20 years, grows to approximately $215,000. At 8%, roughly $230,000. At 10%, somewhere around $260,000. Compare that to Daniel's whole life cash value, $60,000 to $90,000. The gap between those two outcomes is somewhere between $125,000 and $200,000. That number has a name. It is the price of 2 in 1. Daniel paid for the convenience of bundling, and that convenience came with a 6-figure penalty embedded quietly in year 1. The product that promised to do 2 things at once turns out to do both of them worse than 2 separate, simpler, significantly cheaper products would have done each individually. And Daniel doesn't know this, because page 1 of the illustration doesn't show the comparison. It shows his numbers in isolation, illustrated as favorably as legally permitted. The term plus invest alternative is not on any page of any document he's been handed. Now let me tell you what happens next. Because if you've ever been in one of these conversations, or if you ever find yourself in one, there is a very specific move that comes next. I know it because I used to make it. You raise the math. Maybe not as precisely as I just did, but you push back. You say, this seems expensive for what I'm getting. What if I just bought term and invested the difference? And a trained agent, a good agent, will say something like this. That analysis only works if you actually invest the difference. And most people, honestly, don't have the discipline to do that consistently on their own. This product automates it for you. It protects you from yourself. I said that sentence many times, in living rooms exactly like this one. Let me be very clear about what that sentence is. That is not an argument about the product. That is an attack on your psychology. The moment an agent pivots to, you lack the discipline, the conversation has shifted from, is this product mathematically superior to the alternative, to, are you the kind of person who can be trusted to manage your own money? Notice that shift. Hold it clearly in your mind, because once you are defending yourself, explaining that you are disciplined, that you would invest consistently, that you're not that kind of person, you have left the product entirely. The math hasn't changed. The commission structure hasn't changed. The gap I just showed you hasn't closed by a single dollar. You've just been moved to different terrain. And let me be fair here, because fairness matters. The underlying observation is not always wrong. Some people genuinely benefit from savings mechanisms that are automatic, built in, and harder to liquidate on impulse. Behavioral finance is real. Inertia is real. Studies consistently show that forced, automatic savings mechanisms produce better outcomes for a meaningful portion of the population than voluntary ones do. If you genuinely know, that you would raid a separate investment account the moment a difficult month arrived, that is relevant information about your situation. But here is the distinction that never gets made in that living room. The answer to, I struggle to save consistently, is not necessarily buy a high-commission permanent insurance product. It could be automatic transfers on payday. It could be a workplace retirement account with pre-tax contributions that never touch your checking account. It could be a dozen other structures that cost a fraction of what you're about to commit to, and that still solve the discipline problem directly. You might struggle with consistency. It's a conversation about your behavior patterns. It is not a financial argument. It is not a justification for a $150,000 gap in outcomes over 20 years. The person who made the discipline argument never showed you the alternatives to the discipline problem. They showed you one solution, theirs. If an agent tells you that you lack the discipline to manage your own financial decisions, The correct response is not to defend yourself. The correct response is, let's get back to the product. Once you can name what's happening, once you recognize it as a psychological redirect and not a mathematical argument, the move loses almost all of its power. You're not being emotional, you're being handled, and now you know it. Now, let me be honest in the other direction, because this matters. Whole life insurance and its variants, indexed universal life, variable universal life, the various flavors of permanent coverage that travel under different names but share the same basic architecture. These products are not universally, for every person, in every situation, the wrong choice. There are legitimate use cases. Estate planning at very high net worth levels, where the tax mechanics genuinely change the calculus. Situations where an individual has already maximized every available tax-advantaged structure and still has surplus capital that needs a home. Specific business succession arrangements where the death benefit creates liquidity at a moment of genuine need. Certain estate considerations for large, complex estates where cash at death matters more than return on investment. These are real scenarios. They are legitimate applications where the mechanics of whole life make sense on the numbers, where the commission structure, while still substantial, gets absorbed into a plan that justifies the trade-off. The problem is the distribution of who is actually being sold these policies. The average household income in America sits around $70,000. The primary target demographic for whole life insurance sales, the people receiving kitchen table presentations and office appointments and video calls, are families earning between $50,000 and $120,000. These are people, in most cases, who have not yet maxed out their other options, who are nowhere near the estate complexity where whole life's tax mechanics become genuinely relevant, who have available structures they haven't touched yet that would serve them significantly better at a fraction of the cost. The product designed for a $40 million estate is being sold, at scale, to people with $80,000 household incomes, because that's where the volume is. The estate attorneys and CPAs actually serving high net worth clients have independent advisors and accountants reviewing every piece of this. They run competitive analyses. They have people paid specifically to push back on the illustration. They are not getting a warm, unhurried presentation in their living room on a Tuesday evening. You are. And here, and I've been inside this system, so I want to be careful, most insurance agents are not bad people. Most of the people I knew in that industry went in because they genuinely wanted to help families. They believed in what they were selling, or they learned to believe it, or they were in an environment where the belief was simply the water they swam in. The product being prioritized in that conversation doesn't have to be the highest commission option available, but the incentive structure points in one direction. 70 to 110% commission in year one creates motivated, skilled, emotionally intelligent professionals who are exceptionally good at sitting with you in difficult moments and guiding you toward a very specific outcome. The system isn't broken. It's working exactly as designed. Understanding that doesn't make the agent your enemy. It makes the commission structure something you need to account for when you evaluate the advice you're receiving. The advice is not coming from a neutral source. No advice ever does. What matters is whether the source is transparent about where they stand. At the beginning of this video, I told you I had one question. Here it is. When an agent is presenting, at your kitchen table, in an office, on a video call, ask this: what is your commission on this product? That's it. That's the whole question. Not hostile, not accusatory, calm and direct, as if you're asking the time. Now let me tell you what that question actually measures. Commission is not evidence of wrongdoing. Every professional in this industry earns income. Commission-based compensation is a legitimate structure. The question isn't whether a commission exists. The question is whether the person across from you is willing to be transparent about the size of it relative to what you're paying, and relative to what they would earn on alternative products they could have recommended instead. An agent who answers directly, gives you a number, explains the first-year structure, continues the conversation without shifting in their chair, has just demonstrated something significant. They are willing to discuss the conflict of interest openly. They can hold both things simultaneously. I earn a significant commission on this, and I still believe this is right for your situation. That is a conversation worth continuing. That is a professional worth your time. An agent who deflects. Who says that's proprietary information? Who tells you to call the home office? Who changes the subject with sudden momentum? Who gets visibly uncomfortable and reaches quickly for the next page of the illustration? That agent has already answered you. They've told you that the conflict of interest is something to be managed around, not disclosed. And that tells you something important about everything else they're about to say. 30 seconds. One question. You'll know more than you would from 2 more hours of presentation. There's a related concept worth understanding, because it maps directly onto this and applies far beyond insurance. A fiduciary is a professional who is legally required to act in your best interest. Not suitable for your general situation. Not appropriate for someone broadly like you. Your specific best interest, given your full financial picture. Most insurance agents and many financial professionals operate under what's called a suitability standard. The product simply has to be reasonably appropriate for someone in your general circumstances. There is an enormous gap between suitable and optimal, and that gap, compounded over decades, tends to cost people very significant sums of money. When you're in any significant financial conversation, 2 questions give you the map of the terrain before you begin. Are you a fiduciary? What is your commission? The answers will tell you more about the conversation you're about to have than anything that follows them. 11 years. I was good at it. Genuinely good. I had conversations that helped families think clearly about protection and planning for the first time in their lives. Some of those policies, for some of those people, were genuinely the right product for the right situation. I believe that. And I steered a lot of people toward a product that paid me exceptionally well and served them significantly less well than the alternative would have. Both of those things are true at the same time. I've made my peace with that, more or less. I don't think I was a bad person then. I think I was a well-compensated professional inside a system that didn't particularly reward honesty about its own structure. Most systems don't. The people sitting in those living rooms were not naive. They were not financially careless. They were not unsophisticated. They were in an emotionally raw moment, scared for their families, wanting to do the responsible thing, and they were being offered certainty. The feeling that someone competent, someone who genuinely cared, had sat down with them and taken care of it. That feeling is worth something. I understand why people buy it. Certainty is just the most expensive feature available in any financial product. Almost always more expensive than it appears on page 1 of the illustration. Now you have the math. Now you have the question. What you do with both of them is entirely yours. My legal team has reviewed this script. They've asked me to clarify that nothing here constitutes financial advice. They've also noted, unprompted, that they switched to term insurance after watching the rough cut. I'm not drawing any conclusions from that. If you've sat across from one of these presentations as a buyer or as someone who used to sit on the other side of that table, drop it in the comments. The pattern repeats in very specific ways, and your experience probably maps onto someone else's almost exactly. And if you know someone who is about to have this conversation, Send them this video first, not to tell them what to decide, just so they're sitting down with the hood already open.